Today we are going to study sinking fund method of charging depreciation. Now how this method is different from other methods of charging depreciation. In other methods, whatever we charge as depreciation remains invested in the business itself. And what may happen? That at the end of useful life of the asset, we may not have enough cash with us to buy its replacement. Okay, actually in this method, this problem has been countered. The procedure of this method is that each year, whatever is charged as depreciation is invested in outside securities. And at the end of the useful life, all those investments are sold and a new machinery or a new asset is bought. This is the summary of the procedure, though I will be telling you it in detail. Let us first decide how we find out the amount to be charged as depreciation in this method. Now in this method, our thought process is like this. If we need, say, ₹1 at the end of, say, 3 years, how much we must invest at the end of each year to get that ₹1? Okay, let us see if we need to invest X amount. Say if the asset's life is 3 years, if we invest this X amount at the end of first year, then it will remain invested for 2 years, say at the rate of 5%. So this will become, this amount X at the rate of 5% after 2 years will become this amount. Similarly, at the end of second year, if we invest X amount, it will remain invested for 1 year. And at the end of third year, if we charge depreciation X, now this amount is not to be invested. Rather, these two securities have to be sold, plus this amount should be equal to ₹1. Okay, so this is the equation we get. So what shall be X? So if we calculate this will become and let us total all these amounts. 1.1025 plus 1.05 plus 1, this one. This will be 3.1525. This should be equal to X, and this amount comes to .310708, so we can say 3171. So for example, if you buy a machinery for say 60,000 and its useful life is 3 years, and at the end of 3 years you will get 10,000 as scrap value. So that means to write off 50,000 or to get an amount of 50,000 at the end of 3 years, you must invest, to get ₹1 you must get this much, and to get an amount of 50,000 you must invest this much amount. Now this will come to 15,855 rupees, 15,855. That means if we invest this amount at the end of first year at compound rate of interest 5%, and at the end of second year if we invest 15,855 for 1 year, and at the end of the third year if we charge depreciation 15,855, all these three amounts together will become 50,000. Okay, this is one way of calculating it. Another way of looking at the same thing is that if we buy an annuity and if invest as an annuity of ₹1, what it will become at the end of, say, third year. So if we invest, say, 1 rupee, that is, this 1 rupee again will be invested for 2 years, and this 1 rupee will be invested for 1 year and will become this much amount, and in the last year annuity will be 1, and this will become how much? 1.1025 plus 1.05 plus 1, this is 3.1525, 3.1525. That means an annuity of rupee 1 for 3 years will become this after 3 years. This is the future value. Okay. So we can simply say, if we need 50,000 at the end of 3 years, what shall be the amount of our annuity? It can simply be worked out like this, into 50,000, and this will again come to, so you can look either way, but the result is same. Now I will tell you what kind of journal entries are passed each year and how the whole thing is rounded off at the end. Okay. Now I will explain you the entries to be made in this method. Now at the end of first year, first of all you have to charge depreciation. So the entry for that will be depreciation to depreciation fund account with amount 15,865. In normal cases, the entry is depreciation account debit to machinery, but that entry is not to be passed now. Now in this case, depreciation to depreciation fund account. This is for charging depreciation. Now, as you know, this amount we have to invest. So the entry shall be depreciation fund investment account debit to bank. We have invested this amount in the outside securities at 5% interest rate for 2 years, because at the end of third year we want to sell these securities so that we could buy the new asset. Okay. Now, as usual, depreciation should be written off to P&L account. So our entry is profit and loss account debit to depreciation 15,865. Okay. Now, at the end of second year, again as usual, we have to provide depreciation. Entry is depreciation account debit to depreciation fund account. Right. Now in the second year, at the end of second year, we will get interest on this investment which we made. 5% of this we will receive as interest. So entry for that is bank account debited to interest on depreciation fund investment account, that is 793. This is 5% of this investment made by us. Okay. Since now this interest has been received on behalf of this fund, depreciation fund, so it should be transferred to depreciation fund. So for the transfer, the entry will be interest on depreciation fund account debit to 793. Actually I have written here as, that means actually sinking fund investment account. Let us make as for our entries depreciation fund investment account. Okay, interest on depreciation fund investment account to depreciation fund account. Now after that we have to invest. What we have to invest this year? We have to invest this amount of depreciation which we have charged plus the interest received by us. So this amount 15,865 plus 793 is invested. The entry is depreciation fund investment account debited to bank 16,658. Okay. Now as usual we have to write off this depreciation to profit and loss account. So entry is profit and loss account debited to depreciation account. Okay. Now in the third year, in the last year, as usual, we will charge depreciation, okay, but we will not invest this amount, okay. We will receive interest on both the investments made by us. First is this investment, second is this. On these two investments we will receive interest. Then again this interest will be shifted to fund account, like interest on this fund account to depreciation fund account. Again this entry will be made, right? All these investments, two investments will be sold, okay, and if profit is made, that again will be transferred to depreciation fund account, right? Then all the amount we have collected in the depreciation fund account will be credited to asset account, and then asset will be sold, and the profit made or the loss, whatever is at the debit or credit of the asset account, will be shifted to profit and loss account. And at that time we will have enough money with us to buy the new asset. Now I will explain you all those entries which we will make at the end of third year. Now I will explain you the entries we will make at the end of third year. At the end of third year, as usual, we will charge depreciation, and the entry will be depreciation to depreciation fund account 15,865 as usual. Then we will receive interest on the two securities we have. That is, first we invested at the end of first year, and the second one which we invested at the end of second year. 5% on them we get. So these are the amounts. This is 16,658. That is the first year's investment, which has already become 16,658, and 15,865 which we invested at the end of second year. On this total amount we will receive 5%, which will amount to 1626. Entry will be bank account debit to interest on depreciation fund investment account 1626. Okay, then of course this interest will be shifted to depreciation fund account, and the entry will be interest on depreciation fund investment account debit to depreciation fund account. Okay, now this is the time we have to realize our investments. So when we realize investments, could be we make some profit on our sale, or could be we make some loss. If we make a profit, for example in this case we make a profit of 851, we sell our investments for 35,000 and their book value is 34,149. So we are receiving in bank 35,000, so bank account is debited to depreciation fund investment account 34,149. This is the book value of the investments with us. 851 is the profit made by us. Since this profit is made on investments belonging to depreciation fund, hence this profit has been taken to credit of depreciation fund account and not to the credit of profit and loss account. Okay, so this 851 is to the credit of depreciation fund account. Now we have already collected in our depreciation fund 50,865. Our intention was to collect 50,000, so our purpose has been achieved. Now this depreciation fund will be shifted to the credit of machinery account, and for that entry is depreciation fund account debit with the amount which is standing at the credit of depreciation fund account. So depreciation fund account debit to machinery account with 50,865. Next is we have to sell our machinery, which we had anticipated in the beginning to fetch us 10,000, but it is sold for 9,500. So bank account debited to machinery 9,500. Now at the moment there is a credit of 365 rupees in the machinery account. So that means it's a net profit for machinery. So it will be shifted to profit and loss account, machinery account debit to profit and loss account. If by chance there was some loss, then this entry would have been reversed. Profit and loss account would have been debited and machinery account would have been credited. Now in the last, we have to charge depreciation to profit and loss account. So entry will be profit and loss account debited to depreciation account. That means the depreciation we charged in the last year has been debited to profit and loss account. Okay, I hope you have clearly understood the sinking fund method of depreciation. Now we will move on to the insurance policy method. Now I will explain you the insurance policy method of charging depreciation. You know, this is also a kind of sinking fund method, but the only difference with the previous method is that in this we don't try to invest in the market, that is the amount charged as depreciation. We don't invest ourselves. Rather we go to an insurance company, general insurance company, and buy an insurance. Okay, we just pay premium at the beginning of each year, and at the end of the useful life of the asset or the machinery, whatever it is, they pay us the promised amount. Okay, now this is the system. Let us see how the entries are made in this system. First of all, at the beginning of each year, we pay premium for the insurance. Entry for that is depreciation fund policy account debit to bank. This is the amount of premium we have to pay to the insurance company, for which they will pay us the insured amount. Like in our example, the machinery is costing us 60,000 rupees, and we know the salvage value, expected salvage value of that machinery is 10,000. So that means we have insured, we have taken insurance for 50,000 rupees, and 16,000 is what we need to pay as premium at the beginning of each year. So this entry is for making payment to the insurance company. Second, depreciation account debit to depreciation fund account. This entry is made at the end of each year. This is basically charging of depreciation and creation of depreciation fund account. Okay. Third entry is charging our profit and loss account with depreciation account, 16,000. All these three entries are made throughout the life of the asset, all the years. But in the last year, of course, these three entries will be made. Other entries to be made are, first of all, you will realize the insurance policy. Like in this case, we had insured it for 50,000. So when we get money from insurance company, the general entry is bank account debited to insurance policy account 50,000. And you see, in all these 3 years, we have been paying 16,000 as premium. That means in 3 years, we have paid 48,000. And we are getting 50,000 from the insurance company. So we have made a profit of 2,000 rupees. And this 2,000 of profit need to be transferred to depreciation fund account. And for that entry is insurance policy account debited 2,000 to depreciation fund account 2,000. Each year depreciation fund policy account has been debited by 16,000. So in 3 years, we have debited the insurance policy account with 48,000. And it has been credited with 50,000 here. Hence, there is a credit balance of 2,000. This is the profit. This is what we have transferred to depreciation fund account. Having done this, now we move on to transferring the depreciation fund to machinery account. For that entry is depreciation fund account debited to machinery account. That means whatever is lying at the credit of depreciation fund account, it was meant for creating money for buying a new machinery. Hence, this is being shifted to machinery account. Now, we sell our machinery. It was expected to sell for 10,000, but by chance, it could not. We sold it for rupees 9,500. So, entry is bank account debited to machinery 9,500. Here in this, we have made a loss of 500. So, this loss, which is standing at the this is standing as debit balance in the machinery account, 500 rupees. Now this will be debited to P&L account. I will explain you. In the machinery account, there is a debit balance of 60,000. That is when we bought the machinery. Okay, and 50,000 has been credited here from depreciation fund account to machinery account, 50,000. So now there is a debit balance of 10,000 in the machinery account. After selling it, we get 9,500. So machinery is being credited by 9,500. So now only 500 is left in the debit side of machinery account. Now only 500 is left in the machinery account. That is the debit balance. Actually, this is the balance which has not been written off as depreciation. So now we write it off to profit and loss account. Hence this entry, profit and loss account debit to machinery with 500 rupees. I hope the whole thing is very clear to you. And now we move on to the annuity method of charging depreciation. Now I will explain you the annuity method of charging depreciation. Before I tell you about the method, you must understand the meaning of an annuity. An annuity is an amount which is paid annually or received annually, and it is a regular amount. That is the same amount either given or received annually is called an annuity. In the annuity method, the thinking is that whatever we have invested in an asset is basically has some opportunity cost, that if this amount was not invested in this asset, it could have been invested somewhere else and it would have earned us some amount, maybe some interest. So this is the thinking behind this method. In this method, interest is charged on the amount outstanding in the asset account. For example, if we invest in an asset 30,000 rupees and we consider 10% to be the appropriate rate of interest, that means in the first year 10% of 30,000, that is 3,000, will be debited to asset account, right? And while calculating the interest to be written off each year, we have not only to consider the cost price of the asset, that is 30,000, but also the interest which we have debited to the asset account. Okay, this method is useful in case of all those assets where we make lump sum payment in the beginning and nominal values or nominal amounts are paid annually. For example, in case of leases. So this method is appropriate for such cases, but it can well be used in other assets as well if you feel that it's very important for you to consider the opportunity cost of the capital or the money invested in the asset. Now let me tell you how to calculate the amount of depreciation in this case. Okay, before I go to that, let me ask you one thing. Don't you find some similarity between the amount invested in an asset and depreciation to be charged? Just same or just similar to the one, like if we have given loan to somebody and he is returning us in installments, and those installments include interest also, isn't it? So let us have a look at the method of calculating annuity. Here, value of an annuity for a given period of time and at a given rate of interest. In this case, the period we have taken 4 years and interest rate 10%. And this is rupee 1. So if at present there is rupee 1, what is the value of annuity? What is the value of annuity if the rate of interest is 10% and the time involved is 4 years? So let us assume that annuity to be equal to X. So the amount of X received at the end of first year is equal to present value if it is divided by 1.10. That means if it is discounted at the rate of 10%. Similarly, the amount received at the end of second year is discounted for 2 years at the same rate. Similarly for the third year and fourth year. So after calculations are made, we have reached this. So the value of x is 0.31547. That means if we want to write off rupee 1 at the rate of 10% for a period of 4 years, then we must write off depreciation amounting to rupee 0.31547. And if we have invested 30,000, then we will multiply this amount with rupees 30,000, and amount of depreciation will be 9,464. Okay, this is a method by which we can easily calculate the amount of annuity. And let me tell you, there is another formula for this also, which you can easily use. Formula is this: value of an annuity is equal to R multiplied by 1 plus R raised to power n. Here R, their rate of interest, n is number of years. Okay, so for the given data we have calculated here. So this is 10%, this is 1 plus 10%, 4 years, that is n, and this also gives us the same result as this. Okay, and these two options are available to you, and also you have the option of using the annuity tables. They are readily available. Okay, let me tell you one more thing. In case this, out of this 30,000, if we are to receive some money at the end of lease, then how much depreciation should be charged? So in case, for example, if we are to receive 5,000 back from the person from whom we have taken lease, then that means we have to write off rupees 25,000 over a period of 4 years at the rate of 10%, including interest at the rate of 10%. So in this case, this factor will remain same, because this is the value of an annuity for 4 years at 10%. So this factor multiplied by 25,000, which is to be written off, okay, plus interest on 5,000, annual interest, because 5,000 though we will get back, but the person is holding it back, so we need to earn 10% on this amount. So this gives us 7,886.75, and 500 this, total comes to 8,386.75. so we round it off and say rupees 8,387 should be the depreciation charged in this case, in case we are going to get back rupees 5,000 out of initial 30,000 paid by us. Now I will explain you the journal entries to be made in this and how this account is written. Okay? Now I will explain you the journal entries to be made in this method. First of all, when you buy the asset, the entries pass like asset account debit to bank account. The main thing is that at the end of the first year, we charge interest at the outstanding amount, that is 30,000. 10% of 30,000, 3,000, and entries asset account debit to interest account. That means we have debited asset with 3,000 more. That means we are recognizing the opportunity cost of this 30,000 invested in asset. Okay, and at the end of this year, again we charge depreciation, normal entry, depreciation to asset account. This amount, you know, we have already calculated. You know how we calculated it, right? Now after this 3,000 which we charge as interest, with this being the income of the firm, will be credited to P&L account. So entry is interest account debit to P&L account, and depreciation being an expense will be debited to P&L account. Okay. Now each year all the entries pertaining to interest and depreciation will be passed. Of course, interest will be charged on reduced balance. That is, reduced balance means the balance outstanding in the asset account, and these entries to close these accounts to P&L account will be carried out each year. Now I will show you how it happens in the account here. You see here, we bought this asset for 30,000, and on this 30,000, 10% interest is charged at the end of the year, and again at the end of the year, depreciation is charged. This amount 23,536 is carried forward to the next year. Now on this amount, interest is charged at 10%, but our amount of depreciation remains same. This remains same all the years. Now this amount is carried forward to next year. Again 10% of this is charged as interest. Depreciation is charged, this amount is carried forward, and then 10% of this is charged as interest. But here you notice that it is not exactly 10% of this. This is because of rounding off of annuity amount. Okay, so this is depreciation charged in the last year. So this is all over. You see, it's a very easy method, but the problem comes when new additions happen, then we have to recompute the amount of depreciation to be charged. So that is a sort of complexity which comes there. But otherwise it's a good method in the sense that it recognizes the opportunity cost of the amount invested in an asset. But if you look at the other angle, that it does not burden our profit and loss account on account of interest. Though it shows depreciation as an enhanced figure, but whatever interest we charge to the asset account is credited to P&L account. So actually P&L account is not affected by interest, because on the one hand it's credited to P&L account, and on another hand it's part of depreciation being charged. Okay, I hope this method is quite clear to you. Now I will tell you about depletion method and other methods. Depletion method of charging depreciation. You know, certain assets are like wasting assets. For example, oil fields, mines, quarries. You know, here the amount which we can take out of them or the total production can be fairly expected, that you can really calculate it well. In such cases, the important thing is how much we can take out of those wells or quarries. And lifespan is not all that important. So in such cases, the depreciation charge is calculated like this: the rate of depreciation per unit. That is the original cost of the asset which we have paid and less expected salvage value. Now this amount is divided by expected output. Expected output means during the lifetime of the asset what we can expect to take out of it. Okay, for example, if we pay 5 lakh for this asset and the expected salvage value is 50,000, that means we have to write off 4,50,000 over the total production, and expected production out of this is 9 lakh units. That means 4,50,000 divided by 9 lakh comes to 50 paisa per unit. That this is the amount of depreciation we must charge on each unit produced during each year. For example, in a particular year, we have produced 80,000 units at the rate of 50 paisa per unit. That means we must charge 40,000 in this particular year. So depreciation varies from year to year depending on the amount of production we have done. Okay, this method is suitable only in case of wasting assets, right? So I think it's fairly simple method, and now I will tell you about the other methods. Machine hour method of charging depreciation. This method is used where we estimate the life of the asset in terms of expected hours, expected working hours, and not in terms of years. Okay, so the rate per unit is calculated like this: original cost of the machine less its salvage value divided by useful life in terms of expected hours. Like if we paid 5 lakhs for this and 50,000 is its salvage value, and this machine is expected to produce 1,50,000 effective hours, okay, then the rate works out to rupees 1.50 per hour. Okay, Now the amount of depreciation which we shall charge each year will depend on this, how much hours we have produced or for how much hours this machine has worked. So in case of depreciation, it will be rate multiplied by actual hours. For example, if we have worked 30,000 hours in a particular year, then the rate is 1.50 per hour. So the depreciation comes to 45,000 rupees for this particular year. And again, this varies from year to year depending on the effective hours produced by us or worked by us on this particular machine. I hope it is quite clear.